Hello there, Salim Omar here, president of Straight Talk CPAs. I am super excited about what we're going to share with you. It's a topic that we get asked a lot in our CPA firm. It's tax strategies for short-term rentals. We're going to talk about what qualifies, how to save, and what to watch for. I'm joined by our tax advisor, Sabir. Sabir, welcome.
Yeah, thank you, Salim.
Yeah, this is a topic we get a lot of clients that are in the real estate space are wondering, like, what are the benefits of short-term rentals? They're reading stuff or watching stuff about it, and they want more clarification. So we're gonna dive in and give you the 30,000-foot view of what it is, what you should know. So let's dive in, Sabir.
Yeah. So the first one is everyone must be wondering what is a short-term rental. So it is already defined in the IRS. So generally the myth is around short-term rental, mid-term rental, and long-term rental. So there is nothing like mid-term rental. Either it is a short-term rental or it is a long-term rental. So the first condition for short-term rental is the average customer stay should be 7 days or less. So that qualifies it as a short-term rental. Now, if it goes above 7 days, but still it stays below 30 days, then it will be termed as a short-term rental, but you have to provide a substantial services. Now, once you you must be wondering what is the substantial service. So this is like a hotel services where you provide maid service, cleaning services, meals, and other. So it's like same as hotel services. So if you provide substantial services, then even if the average customer stay is more than 7 days, it qualifies as a short-term rental, but it will be reported on Schedule C, and you will be paying the self-employment tax. But yeah, it serves the purpose of turning your loss into non-passive and taking advantage of the accelerated depreciation.
And we'll talk about that in the next slide, which is really an important point there. So, got it. So the average guest stay, 7 days or less, is short-term rental. And then if their rental stays is under 30 days, it's got to be there's got to be substantial services that are part of that, and you gave some examples there. Got it.
Yes. So now the common platforms are Airbnb and Vrbo, where you list your property and you get the customer from those websites. So that's a very famous for average. Customer stays for short-term rental. Now it is short-term rental is treated differently than long-term rentals by the IRS, because long-term rentals is altogether a different ball game when it comes to the passive activity loss rules. And it classifications whether you qualify for short-term rental or long-term rental, it can drastically change your tax positions and tax bills when it comes to the IRS. Now, this is a brief explanation of what is short-term rental and what is long-term rentals. So as we discuss, if the average customer stay is below 7 days, so that is a short-term rentals, but you have to materially participate in that rental property to convert that losses into the non-passive losses. Now, if it goes above 7 days but stays below 30 days, it can still be you can still take advantage of that by converting it into non-passive. But as we discussed, you have to provide substantial services for those rental properties. Now, if it goes above,
just pause there for a second. MP stands for material participation.
Correct? Yes, material participation.
So short-term rental, if the average stay is less than 7 days, then it is non-passive only if it's material participation.
Okay.
Right? And if it is not material participation, then unfortunately it is passive. And passive is not necessarily good because you cannot write it against your ordinary income. And a lot of people in the real estate space, it could be a side gig. They've got their W-2 income, or they've got another business. Then they're not able to benefit from the losses for the short-term rental because they're considered passive losses, not non-passive. So, folks, you want to be in the non-passive category as much as you can. And we'll talk about what material participation is in a moment.
Now, for long-term rentals, so if average stays goes above 30 days, now it will be treated as a long-term rental irrespective of the activity level. So once it is a long term rental. Now that is a passive rental activity. You can still materially participate in this, but first you have to be real estate professional status. So that reps you see are EPS for non passive, that's a real estate professional status. So I mean that's another caveat from the IRS to limit the losses if you are not the real estate professional status. Now, what is a real estate professional status? So most of the people are confused here. They think they have to get some sort of license, real estate license, broker license to qualify as a real estate professional status, but it you do not require license, but there is some strict quantitative requirements to meet the real estate professional status. So there are basically two. First, you have to put in more than 750 hours in the rental activities. So I mean, if you only have rental activities, then that is a rental activities, or else it is entirely like real estate trade or business. So it involves everything other than rental as well, like development, anything related to the real estate. So you have to put in more than 750 hours in the entire year. Then you have to put in more than 50% of your personal time into these real estate trade or business activity. So for the folks who are already employed full time with their jobs, this is very difficult because you cannot put more than 50 hours. So if you are putting more than 2000 hours at your job, then you have to put more than, I mean, 2001 hours. So that's like more than 50% of the total time. So that's bad news for the people who are employed, but yeah, you still have the benefit of short term rentals, and you can, because we will talk about the material participation in the coming slides, but it is what it is for long term rentals. Now, so would you like to go here, Salim, after
Yeah, no,
in
that's
between?
great. Good stuff there. No, cool. Please proceed.
Yeah. So for short term rental, I mean, let's say you have proven your material participation in short term rental. Now what? So whatever loss you are getting from that activity, you can use those losses to offset your other income. Like if you are receiving other K1s or your W2s, any active income, you can offset those losses from the STRs. Again, for long term rentals, you have to qualify for a real estate professional status to offset your active income. There is another rental allowance for 25,000, but it is for the folks who are earning less than 100K. For like whose AGI is less than 100K, they will be able to use that 25,000 rental allowance. But again, it phases out from $100K to 150K. So once your AGI is above 150K, you will not get any allowance, even if it is a long-term rentals.
Got it. Cool.
Now, another, I mean, let's say you have short-term rentals, you qualify for average stays less than 7, you materially participate. Now, what you have a normal, you have a normal expenses that is not creating much of a loss for you, because that's not the ultimate purpose to create a cash loss. So if you are doing a cash loss on your short-term rentals, then you need to change your rental because you are not there to for the losses. The I mean the other picture here is cost segregation on your rental properties. So once you materially participate and that is a non-passive activity for you, what you can do is you can do the cost segregation study. In this study, they will reclassify some of the items of the property to 5-year and 15-year property, because these recovery period properties qualify for bonus depreciation. Now, luckily, from 2025, 100% bonus depreciation is coming back. So whatever amount is reclassified for 5 years and 15 years property, you will be able to write off it entirely in the first year. So this is where you can merge short-term rentals and cost segregations and take the full advantage of this. So this is like a notional loss for you, depreciation, and you can use that loss to offset your active income from wages or any other source of income. Now, the is 100% bonus depreciation was available in 2022, and after that it decreases 20% each, like 80, 60, 40 from 2023 and so on. So that is, but we are hoping to pass that bill. I mean, the Senate will pass the 100% bonus depreciation bill, and you will get back your bonus depreciations for 100%.
Very good.
Now here it is, the material participations and non-passive loss, the main piece of this puzzle for the short-term rentals. Now there are 7 criterias enlisted by the IRS to qualify for the material participation, but these three are the major one by which a person can easily qualify for the material participation and non-passive activity. So first one is like 500 hours. So you have to put more than 500 hours in the activity in that rental property to be termed as materially participating. Now another one is 100 hours. So you must be wondering, like, I would always go for 100 hours, why 500 hours? But there is a little caveat for 100 hours. So you have to put in more than anyone else. So if you have a property manager, if you have a contractor or people working on your rental property, so nobody should put in more than 100 hours more than you. So only you must be the person who is involved substantially in that rental property. So I mean, if you put 500 hours, you do not have to worry about 100 hours. Other person can put in 1,000 hours if they want. But if you are putting more than 500, then you materially participate in that rental property. But if you want to go for 100 hours, then make sure you are the one who is putting more than any other persons in this rental activity. And the third one is substantially all the works. It is like if you are not fulfilling 100 hours, then nobody is putting more than 1 hour. Your property is such that you can only put 30 hours and nothing like that. Nobody is putting any other thing hours. Then you can term it as a substantially all the work. But this is very much like a gray area. I would suggest you go for the second one, 100 hours more than, and I think for the entire year in 365 days, you will be easily able to put in the 100 hours. Now, you can't just go to the IRS and say I am the one who put in 100 hours and more than anyone else. You have to keep a detailed logs to prove it to the IRS when they come for you through audit.
If they audit you, then you want to be able to substantiate it. That's a good point. Yes.
Yes. So so you have to put in the detailed logs there for the material participation. Now, this is a small example. So let's say you have purchased the property for 300K and you are able to take a bonus depreciation of 50K by reclassifying some of the property to 5 and 15 years. And by applying this 50,000 accelerated depreciation, you are able to generate a 12,000 loss on your rental property. So you will be able to use this 12,000 loss to offset your W2 wages. So it can save you somewhere between 2,000 to 4,500. That depends on your tax bracket, whether you are in a 10%, 12%, or 35, 37%.
I mean, bonus depreciation 50,000. I mean, if that property is cash flowing in a positive way, right, it could be a profit. However, that profit turns into a loss because of the 50,000. And that is folks, just like an illustration. I mean, that 12,000 could very well be, after taking all the deductions for that rental, it could be 15,000 or 18,000, but just kind of keeping things simple and conservative. We did it at 12,000 and you've got an estimated saving for the typical average, kind of on an average real estate investor, that's a few $1,000s in saving from that one short-term rental property. And I mean, if you've got, 4 or 5, I mean, that can be a pretty substantial tax saving.
Yes, definitely. So now these are some common mistakes which we need to be careful when you are the short-term rental property owners. So one, as usual, failing to take the participation hours. So you have to you have to maintain a detailed log, because sooner or later you may get audited if you are taking a huge advantage of this rental property, because IRS wouldn't like to lose their tax income there. So first one is this, maintaining the detailed logs. Now, misclassifying your services. So if you are putting if your customer average days is less than 7 and you are mentioning this rental property on schedule C, so you will have a loss. Definitely you do not have to worry about self-employment taxes there, but if in case there is a profit, then you will end up paying the self-employment tax. So if the average stay is less than 7 days, then make sure that you report that property on the schedule E and not the schedule C. So that is another, like, more than 50% of our client, they report, I mean, from the previous accountant, they report on the schedule C. So you have to, this is something you need to look out for. Now, another thing is, not all state confirms the short-term rental licensing, because some state does, some state does not. So before purchasing the rental property, before purchasing the rental property, if you already know that you are buying that property for short-term rental, then make sure that that state in which you are buying the property allows for short-term rental licensing and operations. So this is something, another thing you have to look out for. And yep, proactively plan for phase out bonus depreciation. So as I said, hopefully the tax bill will pass and it will bring back the 100% bonus depreciation. But let's say in 2026 you do the cost segregation for the rental property that is already placed in service, so you will not get the benefit of 100% bonus depreciation. You will get the benefit for the year in which the property is placed in service. So if the property is placed in service for 2024, then you will only get the 60% bonus depreciation benefit and not the 100%. So it depends on the placed in service year and not the year in which you do the cost segregation. So that is another thing to look out for. Now,
all right,
just
recap and action steps. So kind of towards the end of this session.
Yeah. So first, as we discussed in the previous slides, you first have to confirm that your rental qualifies as short-term rental. So the things to look out for this point is average stay is less than 7. If it goes above 7, make sure you provide the substantial services. Again, the other one is avoiding self-employment tax by reporting the short-term rentals on your Schedule E if you are not providing substantial services. Now, another, like the bonus depreciation wisely, as I said, don't do the mistake of doing cost segregation in 2025 and 2026 for the property which are already placed in service if you want 100% bonus depreciation. So always look out for the placed in service year. Now, the other important thing here is the material participation. Maintain your log. Not every hours is count towards material participation. There are some like travel hours, investing hours. You can't just put in, and like I was researching these, I was reading these, I was traveling between my rental properties. So not every hours counts towards material participation. So this is like another discussion entirely. So that's another thing to look out for. And yeah, always have the knowledgeable CPA to optimize tax benefit, which can raise the red flags, as I said, like material participation hours, bonus depreciation. So yeah, always helpful to work with the knowledgeable accountants.
I liked about this kind of, this recording or this session, it was a very quick way for a viewer to really know, a real estate investor to understand kind of the bigger picture behind short-term rentals, the 7 days, the 30 days, material participation, passive losses, non-passive losses, Schedule C, Schedule E, the self-employment tax thing, the cost seg thing. So love what we just did in a few minutes there. Yeah, this was great. Folks that are watching this, hope you got a lot from this session, and we're going to keep creating more and more of educational stuff, materials that we come across as we are servicing clients. Thanks for watching it. Take care. Bye.